Are you worried of running out of cash for your business? Do you find your business does not have the money to pay bills? Or do you run short on cash for payroll? In this video, I'm going to show you how to create a cash flow statement to better manage how your business is spending money. Hi, I'm Josh from the University of Verne Small Business Development Center, and here at the SBDC, we help small businesses start and grow with free one-on-one consulting and free business resources just like this one. And check out the companion article for links in the description down below. So keeping track of finances is hard for many business owners, and many of our clients get overwhelmed for the fear of messing up all of their accounting. What if you could have a simple document that was generated automatically to show the flow of cash into and out of the business, and know if you could meet your business obligations? In this video, I'll explain what a cash flow statement is, the components of a cash flow statement, and how to use it for your business. The statement of cash flows is the last of our three basic financial statements the business owner can use to track their business finances. The cash flow statement is used to perform a cash flow analysis or to determine the liquidity of the small business. The cash flow statement is created automatically through some accounting software like QuickBooks or Wave Accounting by running a report or arranging a copy from your accountant or bookkeeper. If you were to build this statement by hand, it's compiled from the balance sheet and the income statement. But we'll touch on where these numbers come from and how it all affects your business. Now, there are a couple of different ways the cash flow statement is compiled: direct and indirect. Now, the direct method is calculated when cash is paid, receipts from clients, and when payments are made in salaries. The direct method is easiest for most small businesses when using the cash basis of accounting. The indirect method adjusts for non-cash items from other statements to identify an accurate cash flow. So the cash flow statement is broken down into three separate sections that show the inflows and outflows from operations, investing, and financing within the business. So let's take a look at each section. The cash flow from operations identifies the inflows and outflows of cash due to operations. Now, this will include receipts for payments to your business for delivering a product or service. Outflows of cash can be payments for materials, to suppliers, or for wages from payroll. This information would come directly from the income statement for receipts or payments for materials and suppliers. Payroll costs would be compiled from the payroll numbers from your 940 that would show exactly what you pay to employees. Cash flow from investing activities. This section shows business purchases of assets like equipment, buildings, and marketable securities for cash payments. In our example, we see an outflow for a payment for equipment purchase of $40,000. This amount comes from a one-time expense for home office equipment found on the income statement. Cash inflows accounted for this section would include receipts from sales of an asset like equipment, buildings, or securities. Cash flow from financing activities. Now, the final section of the cash flow statement includes sources of cash from investors or banks, and these inflows would be shown as capital raised from loans or equity. Outflows of cash would be payments of dividends, stock buybacks, or payments of outstanding loans. In our example, the statement includes $60,000 in loan payments for a bank loan of $400,000. Now, we'll get this information on the $400,000 bank loan from the balance sheet, but the $60,000 will be made in individual payments made during the period. Now, besides analyzing the general liquidity of the business, there are a few ratios that compare the cash flow statement and two other financial statements. The first ratio is the current liability coverage ratio. Now, if you remember from our balance sheet video, a current liability is one that needs to be paid within 1 year. This means that the ratio indicates a business's liquidity if they can generate enough cash to pay those obligations within that 1 year. The ratio does account for dividends that are paid to investors for this calculation. And the formula for the current liability coverage ratio is this. Current liability coverage ratio equals the net cash from operating activities minus cash dividends divided by average current liabilities. And from our example, the net cash from operating activities is $168,000. But since we don't have any dividends that we pay, this will be zero. We'll still take the $168,000 divided by $200,000, which comes to 0.84. A ratio of less than 1, like this example, is one where a business is suffering a liquidity crisis. The operating cash flow ratio is the liquidity ratio used to determine if the business generates enough cash to meet basic business operations. Unlike the current liability ratio, this ratio does not include dividends in the calculation. This ratio is also used to determine its short-term liabilities considering dividends, and can be used to analyze a business's health by the business owner or an investor. To determine the operating cash flow ratio, we'll take operating cash flow ratio equals net cash flow from operations divided by current liabilities. Using our example, the net cash flow from operations is again $168,000, and our current liabilities come from our balance sheet, which totals $200,000, which results in 0.84. A ratio of less than 1 means this business is experiencing a cash crisis. Our third ratio is the cash flow coverage ratio. This particular formula is a solvency ratio, which means it's geared more towards the long term. This cash flow ratio determines if a small business can cover long-term liabilities or debt with maturity of longer than 1 year. The ratio formula we use to determine this is cash flow coverage ratio equals net cash from operations divided by total liabilities. From our example, we again use the net cash from operations, which is $168,000. Then this is divided by the total liabilities of $600,000 that we got from our balance sheet. The result of this formula is 0.28, which, if you follow the other ratios, needs to be at least 1.0. But because our result is 0.28, this means that our example business is in danger of defaulting on its debt. The cash flow statement is a powerful and effective document to analyze the liquidity of the business. If you run a small business, then you know that cash is king. And as long as you have the cash to run the business, you're doing well. You also need to understand that cash flow is queen, and maintaining a positive cash flow into the business is arguably the most important metric for any business owner. Tracking your cash flow can be done quarterly, but if you need to be in a good cash position, you should generate this statement once a month yourself or from an accountant. Do you know your cash position and how often you should check your cash flow? Let me know down in the comments below. If you found this video helpful, leave us a like, share, and subscribe to the channel. And don't forget to hit that notification bell to get updates on all of our newest videos to grow your business. Are you looking for help with tracking the financial health of your business? Check out our video on the financial checkup for small businesses with Professor Hassey. Thanks for watching, and I'll see you in the next one.